Here are some of the questions for Chapter 20 that we'll go over. Chapter 20 is the chapter about income taxation of trusts and estates. So Chapter 20, question 14, we'll start out with. And it says here that they want us to compute the federal income tax liability for the Valerio Trust. The entity reports the following transactions for the 2019 year. The trustee accumulates all accounting income for the year. So we'll go ahead and compute that. I'm basically trying to figure what's the tax bill for the particular trust for the year. So take a look at the numbers right here. We'll start out with the ordinary income right here of $500,000. We then look at the numbers here, and one number that isn't mentioned here, it is when you go through the chapter and look at the slides and look at the lecture, is that you have a personal exemption of $100 that you back out. So that's personal exemption of $100. You also have to back out the fees that they were charged to us right here. So the fiduciary fees go right here. And those are $15,000. And we sum those up and we get down to $484,900. So that is my income taxed at ordinary rates. Okay, so I'm trying to figure out what my income tax is on the ordinary portion of it. And so then I pay my tax. And you have to look at your tax tables. This is based on your personal tax tables, this $484,900. And if you might recall from your personal tax class, $484,900 puts you in the upper bracket, so it gets up to 37%. So I'm just going to type in the amounts that you get from the bracket. What you do is you go with 3,076. You add that to 0.37 times the 484,900 minus 12,750. Okay, so if you do that, you get the tax, and that turns out to be 177,772. Okay. So the tax I pay on that is 484,900 is the 177,772. When you have your tax on dividends, okay, and going back to the question, you can see the dividends here are $30,000. So remember that dividends are taxed at a different rate than ordinary income. This is based on 37%, and they're in this example they'd be 30,000 times 20% times 0.2. So if you recall from previous chapters, both capital gains and dividends are taxed at either 0, 15, or 20%. If you happen to be at the 37% tax bracket, you automatically are in the 20% dividend brackets here at $6,000. Then the final thing is trusts have to pay an additional net investment income tax. So on top of these two taxes here, they have what they call the additional net investment income tax. It's 3.8%. And what you do is you take the investment income of $30,000 and you subtract the amount you're allowed to deduct, which is $12,750. Okay, so I take those and I multiply that by the 3.8%. And I get, whoops, I did not do the right number there, 0.038%. Then I get to my number that I want, 656. We should really be rounding these to whole dollars here. Okay, so I get 656. So my tax then is the sum of those last three numbers, 184,428, if I round it. Okay, so that's the total tax. That would be the answer to the question right there. The next question to take a look at is question 16. It's right here. It says for the guest trust retains all of its income items, which include only $100,000 net investment income and $40,000 in profit from an active business operation, Guest incurs an additional tax on net investment income of, and the key here is to recognize what you pay the additional net investment income tax on, and it's only net investment income. So not the 40,000, but the 100,000. So just take the 100,000, and that's what's used to compute the tax. Now, we have to subtract, though, the deduction of $12,750. So I start out with 100,000. I subtract the deduction that I get at $12,750. The net number there then is taxed at the 0.038%. So I go ahead and I do that, and I get a tax of $3,316 because you'd want to enter that in whole dollars. So it's 3316 would be the answer. Okay, the next question is question 17. It says here the Biltmore Trust is a simple trust. Crawford is the sole beneficiary. In the current year, the trust earns $3,200 taxable interest and $8,000 in tax-exempt interest. In addition, the trust recognizes $2,500 long-term capital gain. The trustee assesses a fee of $1,800 for the year. Compute trust accounting income. The trust agreement allocates fees and capital gains to corpus. And then same thing for B, except that it allocates it to income. So it's really straightforward. When you see a question like this kind of know it's pretty easy. So for part A, all you're doing is saying my income is the two components, which is $3,200 plus the $8,000. Okay, that's it. And so for part A, my interest income and my trust accounting income are both $11,200. For part B, and you can kind of just see the numbers again here, these two numbers right here. For part B, I'm saying I'm going to allocate fees to income. So for B, I just simply subtract the fee of $1,800, and then for part B, my answer is the sum of the two, which is $9,500. And the last question we'll take a look at is question 18, and you can see here that it says the Hosted Trust reports gross rental income of $72,000 for the year, and you can see that it says expenses are $55,000, and tax-exempt interest income is $18,000. Under the trust agreement, the trustee is to pay 20% of annual trust accounting income to the Red Cross. So compute their charitable contribution deduction. Okay, so we'll go ahead and do that. So it's really not too tough of a calculation. You start out with what their income is, and their income was two things. We'll go back to the question. $72,000 rent income, $18,000 of tax-exempt interest income. So I go ahead and add those two together. Okay. And then I had expenses, which they told me what those were. They just said my expenses are $55,000. Expenses to get the rents are $55,000. So therefore, I add those two numbers up. I get $35,000 income, and then 20% of that income goes to the Red Cross as a donation, which is $7,000. Okay. So $7,000 goes to the Red Cross. So the second part of the question, though, is really what amount can be actually be deducted. And here's where it gets just a little bit tricky, is because of this $90,000, $18,000 was from tax-exempt interest. If we go back and look at the question, it says it right here from a state bond, $18,000 tax-exempt interest. So for part 2, what I have to do is take $72,000, and then I take $72,000 plus $18,000. Okay, so I get a ratio here. So I take that 72 divided by 90, and that gives me a percentage, 80%, that I multiply by the $7,000 deduction. And then that is what I'm allowed to actually deduct. Okay, so I can now deduct $5,600 on my tax return for the trust. Okay, so I can give them $7,000, sure, no problem. But my deduction is actually only $5,600 because I have a mix of this income includes tax exempt of $18,000. So that's basically 80% is non-tax exempt, meaning I can deduct 80% of the $7,000 contribution. So $5,600 would be the answer. And that is it for Chapter 20.